Good afternoon, everyone, and welcome to this Investing in Germany online roundtable regarding real estate debt hosted by REFIRE and Targa Communications. My name is Andrew Barber, and I am Managing Director of Targa Communications in London. As my German is almost non-existent, I must apologise in advance for any poor pronunciation. During the roundtable, we will be taking questions from the audience, so I would ask that you use the question and answer facility on Zoom. We will try to answer as many as possible over the next hour. Following the global financial crisis of 2008-2009 and the need for increased liquidity in the banking industry, many traditional lenders and suppliers of finance for real estate projects were forced to pull back from commercial real estate lending. Today, a decade later, real estate debt occupies an important position in the market, and it has become an important source of finance for borrowers, providing loans and terms that traditional lenders cannot or will not offer. To examine the impact this has had and to look at the future opportunities for borrowers and real estate investors, we have assembled today a highly experienced panel of experts for you who will be providing you with their views. So let me introduce them to you. Firstly, Mr. Hanno Kowalski, who is Managing Director of Berlin-based Frp Invest GmbH. The business acts as an investment consultant providing access to real estate investments and debt financing for real estate and development projects in Germany. Next, we have Mr. Ralph Kint. Ralph is Managing Director and Head of Real Estate Debt at Edmund Rothschild, our real estate investment management based in Frankfurt. He is a real estate and capital markets expert with more than 2 decades of experience in real estate finance. Our third panelist is Mr. Michael Morgenroth. Michael is CEO of Caerus Debt Investments, the Düsseldorf-based investment consultancy company that specializes in real estate debt and has over 20 years experience in real estate markets. Finally, I would like to introduce our lead moderator today, Mr. Charles Kingston, who is CEO and publisher of REFIRE, the online publication about German real estate for international investors. REFIRE was first published in 2006 and is focused entirely on reporting about the German real estate market in the English language. Charles studied at University College in Dublin and Middlesex University in London and has vast experience in the real estate and finance markets. So without any further delay, I will ask our participants to switch on their video and audio, and I will hand over to Charles.
Well, good afternoon, ladies and gentlemen, and you're all very welcome to this part of the September series of online roundtable discussions on various aspects of German real estate finance. I can see from today's participation list that we've got a really mixed bag of people, a lot of investors, a lot of fund managers, lawyers, brokers. There's a very good cross-section of real estate participants here for this talk. So I think we can guarantee you an interesting discussion. As Andrew said, my name is Charles Kingston. I'm the editor and the publisher of REFIRE, Real Estate Finance Intelligence Report, and we are specialized and focus on the German market, but very much interpreting what's going on in this market for an international audience. We've been in business since about the same time, in fact, as the Frp group started. We're both celebrating 15 years in business this year. That's good to know. We've very much followed along in the professionalization and the development of the German market, interpreting and reporting on for an international audience. So without further ado, I would like to just tell you what our goals are for this afternoon. We've got about an hour. I would like to cover a number of areas. We'd start by having a look at a number of trends in real estate debt finance. Obviously, there'll be no escaping looking at the impact of COVID on the markets which are served, the asset categories. We'll have a look at market potential. We'll have a look at the interest, the reasons for debt finance, who benefits, how the lenders benefit, how the institutions benefit. I'd also like to take a look later on at the role of maybe debt advisors and the role that they're increasingly playing in the marketplace. And then let's take a look at what are the predominant risks that are now prevalent for investors. So without further ado, I'd like to start with you. Michael, you are I think it's fair to say the front runner in this industry. You were one of the first into the business when you started up. Perhaps you just give us a little 2-minute introduction to what you do, and then I'd like to ask Ralph and Hanno also to give a little 2-minute introduction to what they do, and literally 2 minutes because I'll cut you off if it goes on much longer than that. Just say what you do, what your role is, and set the tone for the later discussion. Michael.
Yeah, Michael Morgenroth, founder and CEO of Caerus Debt Investments, based in Düsseldorf. As you said, we have been founded in 2012 and started the business out of a management buyout in 2013, then in 2014 with the first fund. We are specialized in any kind of real estate debt, whole loans, mezz loans, project finance, bridge financing. Have raised more than 2.4 billion of capital since 2014 and have invested more than 2 billion in capital in loans, with a focus on Germany, Austria, Switzerland, and Benelux, but have also started to reach out to continental Europe now. Made an investment in Portugal early this year of 200 million. So that's in a nutshell what we are doing, and I stop it here because it shouldn't be a promotion tour.
Very good, very good. But I do know, I do know when you started your debt, when you started Caerus many years ago, I think I had a lot of questions then about what is all this business about. And of course, in other markets, it was more established, and then moved to, you were the first person, essentially one of the first, to set it up here in Germany. Ralph, would you tell us a little bit about your role also at Edmund de Rothschild?
Absolutely. Good afternoon, everybody. And thank you, Charles and Andrew, for having me. So my name is Ralph Kind. I run the real estate debt team at EDR. As been mentioned before, my team is based in Frankfurt, but we're part of a wider real estate team at EDR, comprising in total more than 130 people spread across 9 offices in 7 countries in Europe. So we have real estate boots on the ground in a number of the Western European countries. And on the equity real estate side, we're already managing 10 billion of assets for our clients. And my mission is really to set up a complementary debt strategy alongside the equity team. EDR itself, just a few words on that one. Obviously, as the name suggests, it's owned by the Rothschild family. We are an international investment manager, also a private bank. In total, the group is managing, I believe it's a 160 billion of assets across liquid and illiquid products. And on the debt side, which is a topic of today's discussion, we're currently in the market fundraising for our first European real estate debt fund, which is a high yield strategy. And along our setup, it's really targeting pan-European markets.
Very good. Hanno, please tell us a little bit about Frp Invest.
Certainly. Thanks for having me. It's a real pleasure being here. As you said correctly, Charles, we've been founded in the same year. Frp was founded in 2005 in Berlin, and since then we've been forming that group as a full service and several times awarded advisory group. We have 2 divisions within our company. For one part, there's the debt advisory business, where we arrange all different types of debt capital for borrowers at an institutional level. That's one part of the business, and within the Frp group, there's also Frp Invest, our debt investment arm, a professional lending platform for institutional investors, where we're offering different types of debt investments of all different kinds, that being on a deal-by-deal basis, or separately managed accounts, or in especially also in debt funds. That said, we are the exclusive advisor of the Frp Mezz Fund, the Balanced Real Estate Financing Fund. That's a 250 million Luxembourg-based regulated mezzanine fund that we've launched about 2 years ago. Our maybe USP summarizes that comes from the founding date of 2005, 15 years in the market with a strong track record in Germany. That's our focus market. And since then, we've advised on about 15 billion in capital over the time. So on average, about a billion each year.
So Frp Invest was a logical extension, in fact, of the activities that you'd been doing in the first 10, 12 years of FRP's existence, bringing together partners who are lending with those who are looking to borrow. And this was a natural extension to set up your own investment fund then to enable institutionals to have full access to a more complete platform.
Absolutely. And it came through just more and more lenders being institutional investors. So as you said, it naturally led into that of spinning off the invest business within that advisory section of our total group.
Very good. I'd just like to say at this point also, and Andrew, I think we have this set up so that if people have any questions as we are discussing things, don't wait necessarily to the end. Send your questions in. There is a way, I think, for people to send in questions. And Andrew, please also feel free to interject if you feel it's timely right then to say somebody's just asked this question.
Yeah, I will do. There's a question and answer option at the bottom of my screen. I'm guessing it's the same for everyone else.
Great. Just have a look at the general trend of what is happening in debt finance at the moment. Originally, and the market niche is to provide an alternative source of lending to the banks. Germany has been considered for years an overbanked economy, and every year I keep hearing the banks saying, "Oh, we're going to reduce our lending." But let's talk about the role of the banks. Let's talk about the raison d'etre also for debt funds here, and what market you are actually serving with your debt funds. Michael.
Well, we are serving the market which banks are just not addressing. In the moment, we can see that banks are a bit reluctant and cautious, as a number of investors are for good reasons. But on a lower basis than they have been pre-COVID. Which is an additional chance for alternative lenders like all the three of us, for debt funds, but also for direct lenders as insurance companies. So we normally like investments where we take not more risks than necessary in order to achieve the returns our investors would like to see, which are mainly German institutional investors. So they have to match or to meet their liability side, which means in whole loans that is target between 3 and 4% roughly.
Yeah, Hanno, are they knocking your door down to facilitate the gap there between non-bank financing and willingness to invest in institutional funds?
Oh, absolutely. There's probably, as Michael said, two different scenarios. There's the pre-COVID time where banks were just naturally given regulations and all the known stuff, stepping gradually out of lending and being more restrictive. But that has been given a full speed up in the last couple of months. We've seen some banks withdrawing entirely, and this is some of the more type local banks, Sparkassen, who said we need to keep our money together, we need to help our corporate clients and provide them with liquidity. We're stepping out of real estate on a short-term basis. We might come back on that end later.
Yeah.
And we've seen banks saying we're just entirely restrictive and saying we don't finance certain asset class. We don't do hotel, we don't do retail. We go down in the leverage points. We only go up to maybe 50% in LTV. Before they were doing 60 or higher, or maybe up to 70. So that has changed. And then there are some specialist banks who are saying they're just focusing on certain topics. And we're definitely filling the gap. And Charles, as you know, we do a MESA report every year, and we've just done it throughout that COVID period. And looking at that, we've seen that compared to last year, the total volume of business provided, financing provided, hasn't gone up much, but the mezzanine part in it has grown. So that tells you immediately, and it was let's say with 20% more in mezzanine tickets, it was only about 5% more in total volume being financed. By that you can see that the mezzanine part is expanding, not at an LTV point to the upside, but it's actually eating slowly into what's maybe considered before a senior stretched loan rather than a mezz component.
Yeah, and I'd like to come back to that a little later on, because the mezzanine report, which I think is due out in November, October?
In October,
mid-October,
yes.
Is often seen by a lot of people as sort of the Bible of the industry. I think this is the 6th issue of it. So we'll be interested in that, and I'll come back to that. Ralph, were these the reasons when Edmund de Rothschild set up a debt fund function, and with yourself as head of debt finance, were these the reasons? What were the reasons that were behind the setting up of yet another fund, a debt fund?
I would say that probably there are two answers to your question. The first one, just to echo on my co-panelists, and I fully agree from the supply side perspective, you have the banks that they've been withdrawing from lending basically since the last crisis in 2007 and 8. But let's not forget from the demand side, i.e. the borrower side. I mean, the borrowers, they're really looking for flexible and reliable capital sources that can actually provide higher LTV financings than the banks are willing to do. So that's one thing. So there's a huge opportunity in terms of finding good lending opportunities in the market. And then the other answer to your question is really to look at the whole thing from the investor standpoint. Mm-hmm. Because one of the key things that investors are looking for is really stable income, reliable yield. And naturally, that is a very attractive product to give you recurring income, but also an attractive risk-adjusted return. Then you have the diversification benefit. So far, many investors only invested in equity products in real estate, so debt is a very sensible way to diversify their risk allocations. And lastly, I would say it's a defensive way of investing into real estate, and you have the security position. So that are the key attractiveness of this product for institutional investors. And my final point is really, if you take one step back and you look at Europe as a whole, so not just Germany, but in the entire Europe, and you compare that with more mature markets like the States, then the share of the alternative lenders, including real estate debt fund managers or debt funds, is still relatively small. So there's a huge growth potential embedded in this European market. So if you bring all those points together, it's actually a fantastic place to set up a new strategic initiative that we've done late last year.
Although the conventional wisdom suggests that Germany has traditionally been a very tough market with the banks, and again, I get back to this, and the banks are saying every year we're going to Basel III, Basel II, and solvency and so on, that the attractiveness for them of lending to real estate is getting less and less. However, most of the big banks haven't in fact cut that drastically on their investment. I guess the reason then is that this adds to pressure, downward pressure on yields. And is that one of the reasons then why Germany is seen as a tough market for foreign debt finance to enter?
Yeah, I think. Sorry.
Yeah. No, Michael, I'll come to you in a second. Yeah, sure. Ralph, go on.
It's a fair comment, but I think, Charles, you need to distinguish between the different types of debt strategies. And I fully agree with you on the senior debt space, let's say going up to 50 or 55% loan to value. Germany is highly competitive still. With the caveat, obviously, that now, given the recession that we've gone into because of the pandemic and everything, even on the senior debt side, banks become more reluctant. They focus more on their core clients and core products. So you're right with regards to senior debt, but I would say anything that goes above senior, so stretch senior, mezzanine, also for product where the underlying collateral is more value add than core,
Right.
That is really the market where there isn't much supply from the traditional lender side, and that's the opportunity for debt funds.
Michael, you wanted to come in there?
I fully agree. Regarding the supply from banks, I'm sure we'll definitely see some more consolidation in the banking market. So that will shrink the supply further. We feel comfortable in this field of debt funds since we founded the business, because we saw that chance very early. As said, especially for institutional investors from the insurance side, regulated under Solvency II. There's no other asset class in the market which offers a better relation between return and solvency capital required than debt, because of the privileges they benefit from, which is mainly loans and bonds compared to other asset classes. So, and as Ralph said, investing in debt is really a smart way to invest in real estate. Any asset manager has a problem what to do with the money, because there are tons of money flowing into the system every month. But where to go? You can't invest in stocks, too volatile. All the other asset classes have too high solvency requirements. So the best relation risk-return wise is being offered by debt. And that's the reason why from the investor side, the demand will remain high. And on the other side, from the side of the borrowers, Ralph already explained why it makes a lot of sense for borrowers, because they won't see the supply they have been used to offered by banks.
Charles, we've had a question come in, which is from someone who's not given their name, so I can't attribute it. But they're asking, do investors look into the real estate debt offerings as real estate or debt investment?
Well, I think actually, Michael, you were touching on that just now, actually. And Hanno, I'm sure you concur. Many of your clients in your fund are both investors in real estate directly and also looking at a segment of their allocation, almost in terms of fixed income and investing in debt funds. Is that what happened?
I would have added that exactly. I mean, many are looking at it rather than at a real estate actually as a replacement for what they've been doing in the past in fixed income. So that's the topic of reliable returns, a lower leverage point, and as my colleagues have pointed out correctly, almost a conservative approach here in lending with good returns. And correct on the that's one point. And obviously, yes, there are different groups that come more from maybe the equity side, who said maybe then are good investors also on the debt side, because they go into a market, particularly in this cycle, at when maybe in the top 10 or 20% of the overall prices with a discount. If you come in with a debt product, you don't go in at 100%. You come in at short-term lending periods, rather 1, 2, 3, 4-year periods, rather than owning the equity over long term. So those that were traditional equity investors look at a more defensive way of getting into real estate. And then you've got those who've always been in financing who look at just bouncing and balancing their portfolios with debt products. So there are three components. There's really the equity ones, the real financing with those with financing experience, and those that look for replacement for fixed income.
Well, your mezzanine report, when it comes out, and it'll be interesting to see what it was, but last year's motto, or the key takeaway message from last year, and of course the world has changed, as we all know, since then, but last year that the conclusion was basically, the snapshot was bigger tickets, fewer deals, lower margins, longer maturities. How would all three of you assess any changes to that over the last 6 months, 9 months, 12 months, certainly over the last from when the report came out to where we are now? Ralph?
Let's pick the pricing point first, perhaps. So margins, and I'm talking now pan-European, there are always nuances between the different countries, but prices and margins have increased both for senior and junior debt, or if the margins are the same, then probably the LTV point is lower. So either way you look at it, debt yield has increased for the lenders, which is obviously very good. I would say the other comment that I'd like to make in terms of tenors, I mean, we also see increased inquiries into, let's say, short-term bridge financings of some borrowers to resolve some issues. Probably they want to buy themselves some time until things have settled a little bit, and then looking for permanent financing. And I guess my last point, other than the pricing and the tenor, is simply that generally speaking, deals just take a little bit longer to get done. That's not only on the financing side, but also on the investment side. But I think here, particularly, all three of us, all debt funds, should have a strategic advantage again over the banks, because we can adapt more quickly to changes in the market and can offer more tailored solutions. So that would be my sort of observation on your question.
Good. And Michael, what would you say has been the primary change since that last takeaway last year from the FRP mezzanine report? I remind
the
bigger
biggest
tickets, fewer deals, lower margins, longer maturities. Ties into what Ralph is saying.
Well, to keep it short, the biggest change is probably it has become a lender's market.
Okay.
It has been a borrower's market more or less in late 19, but after COVID, things have definitely changed and has become a lender's market. Yeah, as already mentioned, LTVs have lowered. Everybody wants to see more equity in the deals, which comes back to the first comment from Hanno or from the report that MES is much more requested. That's just a consequence of the request for more equity in the deals.
Good. Hanno, give us a sneak preview into what we can expect in a month's time.
If I take the points that you just mentioned, we still see the trend bigger tickets, which is maybe a different reason. It's not total volumes going up, but it's also different investors coming into the market, different developers asking for financing, who've maybe done it very professionally in the past with their own network and their own banks in the background. All of a sudden, that's not sufficient anymore. They need to go into the market, and they need to tap new sources going into the institutional investor base, for example. And many of those just don't have the established networks. That's some big demand that we see with names that in the past wouldn't have required our services because they just had their own network being sufficient. That's no longer the case. So we see big tickets.
Okay.
We see another good reason for big tickets. We see structures within, let's say, if you want to call it a junior tranche already, all of a sudden we see different components in there. We see a first and second loss piece. We see a different setup point with senior. All of a sudden these transactions become a lot more complicated. They're no longer just this junior piece that you add on to the senior. It becomes a real structured finance approach on that component, and that you do in bigger tickets. And in that context, yes, in the past there was pressure on the yields. That has definitely stopped. As my colleagues have said correctly, it's either the leverage point is lower and you have the same yield, or the yields have actually slowly gone up. That we definitely see in the report, but also institutional investors heavily still competing over that.
Yes.
And it's not like opening up in yields. At a certain stage, you'll find an investor doing the deal if you go up in your yield expectations too much.
Good. Well, let's look at the there's no escaping the elephant in the room, the effect of COVID on the markets, which has changed things radically in the last 6 months. Let's look at the assets themselves. Let's talk about we're not yet seeing banks fessing up, as they say, to making a lot of extra loan provisions for bad debt, but there is talk of waves of refinancings and failed refinancings coming down the line. We're not really there yet. Let's talk about the assets themselves. What did the three of you think about, for example, some of the more visible assets, office blocks, offices in Germany as an asset class? What's actually going on behind the scenes? Ralph.
So your question is what we think in terms of impact on the actual underlying collateral and the attractiveness for financing. Is that your question?
There will have to be an effect at some stage. There will have to be a reckoning at some stage, and we're not there yet, obviously.
Yeah, I would say that's probably fair to say, and there's first data points coming through that there's a downward pressure on valuations. I would say it's fair to assume that the rental decline that can be observed across the market will have at least a short-term impact on the valuations. However, that will vary across sectors. So I think that hospitality or retail being hit harder.
Investors are going to be changing their strategies, right?
Oh, absolutely, absolutely. And at the end of the day, as a lender, you underwrite the cash flow, and then you need to look through to the underlying, basically, tenant mix or lease structures. And if business models fall apart or are being rewritten, then that has an implication on your debt capacity that you can ascribe to any given deal. But just to finish, the other thought is it varies according to sectors. So retail and hospitality is really difficult, I guess. But on the other end of the spectrum, you have more resilient asset classes like multifamily and I guess also logistics, which is a very interesting asset class to be in. And then in the middle, and I guess you were alluding to that already, Charles, in your question, is the office sector and what happens to office. And my personal opinion on that is really, it's not as dramatic as some people suggest. I'm certainly not subscribing to the view that this is the end of the office class. I think it very much depends on the tenant mix and the location of the specific product that you have. There are good ones and there are not so good ones. So you need to distinguish between them. But I would say that, and probably if we're looking ahead into next year, and I don't have my crystal ball with me, but at some point we probably have also a medical solution to this pandemic, and then probably a lot of the concerns that we have with regards to offices will most likely disappear.
Okay, well, as debt funds, you all also have to, on the one side, ensure that there's enough money coming in, Hanno, into your fund, and Michael into your fund as well. But you also have to be concerned about the quality of the borrowers on the other side. Now, in your case, with Edmund de Rothschild, you've got a big network of in-house asset managers, so that in the event of anything going wrong, at least for a while, there's a certain amount. But Michael and Hannah, the last thing you guys want to do is end up owning assets, right? The last you don't want to have to take them off that.
Definitely not. That would be the wrong message to the market as well. I mean, as being a debt fund provider, the clear message has to be we're in finance and we don't want to own the property, which makes a debt fund independent, and there are no loan-to-own strategies, which will distract actually some investors from investing. So that's clearly something we don't want to go about. But yes, you're correct. Looking at the quality of the borrower is a key one. And that comes at FRP, for example, definitely with the track record and knowing the network of borrowers, of developers that we've known for a long time helps a lot of really looking through of who are the persons, the people acting. So it's not always just looking at the balance sheet, but what have they done in the past? Who has cooperated with whom in the background? How many successful projects have they finished? Have they been paying back loans in the past? And all of that over a long period actually shows the quality. And that said as well, we bring the experience to the table that we've been in the full cycle. I mean, we've been in the market when refinancing has been a topic, and that's something we see as a big strength as well. Something might go wrong. You can never say that there won't be a non-performing loan in a fund. It can definitely happen, but it's about a network to be able to refinance and to set it up before it goes really into a default situation and becomes a non-performing loan where you need to go and execute the equity. That's definitely something to avoid, and that's expertise that debt providers need to have, making sure they can refinance their own portfolio when it becomes necessary.
Yeah. And Michael, I know you did a big deal recently in Vienna, and you've been doing other deals in the Netherlands and Germany. What about, are you taking a different approach also to looking at the borrowing side and who you're dealing with there in closer scrutiny?
No, I fully agree with what Hanno said. No debt fund provider likes to receive the keys, but we are prepared for that situation, and we have to be. Although we don't have on platform behind us, we have preferred partners to handle such a situation. So it's not a threat, which it has been for a number of banks in GFC. You should avoid such situation in order not to be under pressure by borrowers. But the main thing is to look before lending and before disbursing the loan, on the quality of the borrower, on the business model, and also an office investment or an office tenant is running a business model, so it's an operator somehow. So you have to look on office tenants as close as you would look as a normal operating model.
Yes, and of course, in addition to the normal business risks, which have perhaps been heightened in the current climate, one of the topics that everyone talks about these days is ESG and the effect that has both as an institutional investor, making sure that they're cleaner than clean, whiter than white, as they say, but also for you as debt funds to look at who you're doing business with. Is ESG, talk to us about your approach to ESG and how that's changing your criteria, Ralph.
Well, I think you're absolutely right. I mean, ESG is one of the mega trends, and certainly will be there a long time after COVID has been gone.
Yeah.
So I think, as you say, Charles, tenants, they want to stay in buildings with a low carbon footprint. And at the same time, we also have to respect and acknowledge that the investors, they want to allocate their capital responsibly, which means as a logical consequence that we as a lender, we have to take ESG on board as part of the underwriting. And also, quite frankly, once the loan has been deployed and funded, then monitor any, let's say, covenants that you might enter into with the borrower. And we shouldn't forget, on the other hand, that we as lender, we are not the owners of the buildings. So somebody else is in the driving seat. But at the same time, during the negotiations of the term sheet and the facility agreement, obviously, we can check on certain things. And as part of the due diligence, and very practically speaking, when we commission due diligence reports for technical DD or environmental DD, you can add appropriate ESG criteria into that and get a view on that.
Hanno, for your fund, this is a big issue as well, isn't it?
Yes and no, and I would politely disagree with Ralph to a certain degree. And again, referring back to our mezzanine report as well, what we've seen this year, we asked explicitly the question as well, how do you deal with ESG? So we've got, and I would say the message is ESG seems to be my corona victim full time. Before everybody was talking about it, there's huge acknowledgement of it. And there was the public pressure, the Greta Thunberg effect as well. And that clearly was visible with all the investors coming through with ESG questionnaires, but much more focusing on whom are we doing business with. So it's more the manager selection component. Say, what's the corporation behind it? It's much more focused on the S, the social responsibility, and the G, the governance, rather than the environmental component.
Yes.
And all of a sudden with Corona, that's gone almost to a complete standstill. Yes, those questionnaires are still out there, but there's no impact when it comes to investment decision as we can see it in debt. The clear message is, as long as there isn't any visible alpha really coming up, like a really extra return that we can make from it, we will obviously be also in ESG compliant products, but as long as maybe the yield is higher in non-ESG products, we'll go there. And we're not willing to invest into any product that maybe comes at a discount because you'll have a lower return actually because you're in ESG. So what Ralph correctly says, it will be a topic, and it's probably the biggest challenge for the industry with the standstill that's happened here. That the market needs to catch up with it because the demand will be there in maybe 1, 2, 3 years time. But right now, investors are not paying the attention to it that they maybe should do.
Is that your experience as well, Michael?
Yes, more or less. So the pressure is already high from the political side, especially from the EU. And there are a number of institutional investors who have committed themselves to ESG initiatives. So there will be a big pressure from that side. But on the other hand, as Hanno mentioned, there will be, you have to differentiate between ESG products and non-ESG products. And as far as you don't have to pay for carbon dioxide emissions as real estate, so far there won't be a big impact. I think some kind of pricing will come sooner or later. Then it makes definitely a difference. But until then, COVID has really slowed it down. Mm-hmm. But on the other hand, ESG from the investor side is really a big issue, I would say, and it will remain in the market.
Charles, we've had a question on ESG, if I can just interrupt a moment.
Please do, Andrew.
It comes from Benedict Huber. It says, in regards of ESG, what about the sustainable finance initiative of the banks? Are they willing to get mezzanine lenders involved?
Well, actually, if that's what I wanted to add anyway, for debt funds, it will anyway be a bit difficult because ESG is also a big issue for banks. So the investment universe for ESG or under ESG criteria is not that big so far. So banks will really run for ESG compliant properties and financings, which will put pressure on margins in that area. So therefore, it might be difficult for debt funds with their return expectations or requirements to be competitive, at least until a given LTV. But back to your question, if there's a structured finance, then banks will anyway have their ESG criteria, which might be anyway a bit stronger than these of the mezz lenders. So as Ralph already mentioned, we are more indirect active in that area because we are not the owner of the asset. So the owner of the asset has then to fulfill already the requirements of the senior lenders, which in my opinion would probably be stronger than these of the mezz lenders.
Oh, anything to add on that? No.
Absolutely, that's the part. I mean, the key part is the senior component. They will determine where that's heading, and obviously mezz players as the junior partners will follow in that context.
Okay, good. I'd like to raise another subject. It's the subject of debt advisors, which you're all familiar with. Now, a few years ago, when I was talking to the finance director of a big investor who invests all across Europe, and we were talking about this a while back. And I said, do you use debt advisors? And he said, well, we wouldn't. If you'd asked me that 2-3 years ago, I'd have said no way. I can do all this myself. I can deal with all of you guys myself. And yet, the role of the debt advisor has gradually taken hold also here in Europe. It's been more traditional in the Anglo-Saxon world, but it's also gathering pace here in Europe. Do you guys all work with debt advisors, and what do you think? Are the pluses and the minuses, the negatives, the positives? Is it here to stay?
Well, in the last few years, debt advisors have become very normal. But it's normally the borrowers who work with debt advisors because they want to just read the market, who is there and who can provide financing besides the banks. Normally they are paid by the borrowers.
Yes.
And the involvement of debt advisors has definitely led to a better or to a higher professionalism in debt requirements and debt requests. So from our side of view, in our experience, that has been very helpful.
Yeah, but lenders too are looking to develop relationships, institutional investors as well with debt advisors, Ralph, aren't they?
Yes, and I agree with Michael. I mean, you have debt advisors in the market, and I've been a debt advisor in my career before, so I think they're good people in the market too. they do add value, not all of them, but most of them for sure. But from a lending deployment perspective, and I think Michael mentioned it before, we're in a lender's market right now. So there are tremendous opportunities to write good loans. So with that regard, or in that relation, on our side, we don't actually need to hire debt advisors on our side. And let's not forget, I mean, we have 130 people spread across Europe. I mean, some of them hear the grass grow in Holland, in UK, in France, and other countries. So in terms of the sourcing origination, we don't need to rely on debt advisors.
And I guess for FRP, it comes as second nature, Hanno, because you kind of grew up in this world in any event.
That's in our genes, obviously. This is where we're coming from, and that continues. Even though the business is changing a little bit, we're seeing more institutional investors having need for debt advisors as well when they lead, say, more complex deals. Maybe certain club deal partners, access to networks that they haven't had in the past. And one thing is not to forget, most of the institutional investors, even if they're large insurance companies, large pension funds, in some of their debt departments, they work with 1 or 2 people only. They simply don't have the resources to fill their own pipeline. So they're looking for strong help, obviously, on deal sourcing and avoiding some of the massive flood that they see at the moment with deals being thrown at them. They don't have the resources to filter out which are the good ones, and they don't have the setup of a bank with a credit department. So right. That's something. It becomes an extended workbench in some cases as well, where they use advisors just to deal with the workflow in total.
Okay, all three of you are obviously all very bullish about the future opportunities also in the niche sector of debt funds. What, if I may ask, do you see as the principal risks that could cause your business models to wobble or go off the rails? What do you see as the key principal risks coming up in the coming years? Hanno.
Well, one of the things I would have said pre-corona was that the pressures on the margins, on the yields, were starting to be too high. We were seeing some yields and, let's say, some unexperienced lenders doing business at a level where I say it wasn't risk compliant anymore as of what they would finance. Now, COVID is changing that a little bit again, and it becomes again the yields are slowly going up. So maybe that has stopped that, but it's the overall risk is the huge amount of money that's still going into this sector, that there is let's say a pressure on yields, and maybe that overall returns should be slightly higher, reflecting the actual returns. I think that's the biggest challenge of keeping that in balance. And any market that's becomes a strong lender market or a strong borrower market offsets some of those trends for a certain period. I think that's maybe the risk with, even though risk increasing, overall money flooding still and going into it, because there are in some areas no alternatives for investors, having its risk by itself.
But this low interest rate is unlikely to change in the next foreseeable number of years.
Not the overall low interest rates, but obviously there's more room, and this is what we see within, let's say, in the junior part, it's expanding. All of a sudden you see whole loans that have a much stronger mass component. There are some high yield tickets in this as well, a first loss piece structured into it. All of a sudden we see a differentiated approach. And this is something where maybe to the borrower, it seems like a simple whole loan covering this all in one go for them. But actually behind, we see a lot more detail and a very differentiated risk structure. And in that context, also different yield components for investors that can pick certain components from that.
But Michael, you've generally taken the whole loan approach to lending, have you not?
We have done both.
Okay.
But institutional investors preferred whole loan structures, and also did the borrowers, because it's easier for them to speak just with one party, and they have a higher, let's say, deal probability if you don't have to wait until the senior lender and the mass lender has agreed on an intercreditor agreement. So time-wise, it's much faster. Prices have gone up since COVID. Besides that, to come back to your question before, I fully agree with Hanno in terms of liquidity or money flooding in the system as the biggest risk. The need for alternative lenders will remain high, because the banking sector is coming under more and more pressure. And I also expect that we have some medicine, if not next year, then the year after. So life will go on, and business will go on. We have the advantage. We are a bit older, so we have seen a number of crises. The last 10 years, people who started the business 10 years ago, or their career, they only know Chancellor Merkel and Bayern Munich as a German champion. So we have seen a number of crises, and so in that mood, I would say, calm down, and we'll see better times without COVID sooner or later.
And Ralph, you've seen a number of cycles as well, I know. But I take it with Edmund de Rothschild, again, just quickly wrapping up that on the whole loan bit, this is the approach you want to take as well. You don't want to get involved in just small pieces of the capital stack, presumably. You want to be the main man.
Yeah, absolutely. I think the key word is flexibility, and by that I mean you can play up and down the capital structure. And I agree with my colleagues here. The advantage of whole loans is actually twofold. From the borrower's perspective, it massively reduces execution risk, as been mentioned already. But also from the investor's perspective, let's not forget who is giving us the money. It's institutional investors. What is it that they want? They want stable income and a good return. Yep. So whole loans, by funding the entire capital up to, let's say, 70 or 75% loan to value, you have your cash flow component, which is the reliable income stream. But at the same time, you have the implicit junior tranche, which give you a higher return. If you did just do mezzanine lending, quite often you end up in so-called big structures where you don't have a recurring cash flow, but you rely on some value changes or strategies that the borrowers do, and then you get your interest at the end of the term. Not all mezzanine structures do that, but some of them. So I think the whole loan product is really something that will remain awoke very much, and it's part of our lending strategy for the first fund that we're currently launching. Absolutely.
Just wanted to say we'll be hearing more when this fund. Just tell us in a sentence. The fund is coming out this year.
Yes, we have actually launched it already in Luxembourg, and we're currently working on the first close. So it's been quite some experience for me as well on the fundraising campaign, being hit by Corona and the lockdown, which made the logistical component of the roadshows quite challenging, to be honest. And therefore we ran in a bit of a delay, but we're currently planning to do a first close around November this year.
Very good. Well, we'll be hearing more about that. I'm conscious of the time, Andrew.
Yeah,
and you're probably bottling into your clock. Is there any have we other questions from our audience?
There's one which came from Thomas Gutler. Good afternoon, Thomas. He's interested in this. He thinks it's important that investors who come from the equity side can understand it. He says, from a risk-return profile, core plus, value-add, opportunistic, how would you classify senior, whole loan and mezzanine investment strategies? And I'll throw that open to whoever wants to jump in.
Hanno, you're looking frisky. Go ahead.
Hanno, you're smiling.
I think it's a fair question, but you probably need to slice it even further, because if I just look at the mezzanine piece, there's such a wide range. I mean, you see returns, the high end double digit up to 20%, and on the low end, you see mezzanine pieces that are maybe at 5%. So in that itself, you have maybe a core conservative mezzanine piece, and that already up to the highest leverage point on the other end. So, and that's, again, what Ralph said as well, that's the attractive component when you stitch together the senior with the junior, you're getting that overall protection. You get a first ranking mortgage usually on those as well, including your junior piece. So it's not that easily answered as of where that sits. The range is so wide that it really depends on the strategy you want to apply. And there's maybe some risky senior business, and there's very conservative mezz business. Difficult to put that into a box.
Well, maybe Andrew has another easier question for.
Well, yeah, talking of mezzanine lenders, we've got an anonymous question saying Corona-19 is making mezzanine lenders nervous with falling values, rent fallouts, and less transactions. Are you sleeping well at night?
For us, yes. But I can imagine that pure mezz lenders, and especially mezz lenders who have deployed equity mezz, so to say, they have all reasons to be nervous at night, I think.
Okay. Mm-hmm.
As Ralph already mentioned, the reason for investors to have stable income and stable yields, that's one of the big reasons for whole loans, because you don't have the small slice on top of the capital structure or the lending structure, but you have the whole structure. So your loss, if you would suffer one at all, is not percentage-wise not as big as if you are a pure mezz lender, because then you could really wipe out your loan, maybe.
And Ralph, you give the impression of sleeping well at night.
I just wanted to say the good thing about doing the first fund means
no legacy.
So it's a clean sheet that we're starting from. It's all new loans post COVID-19 impact.
Well, that's great. That's great. Andrew, I think we have to wrap it up time-wise, unless you've got anything else there. Have you?
I've got another question, just a quick one.
Quick one, gentlemen.
Yeah, what is the current market share of non-bank lenders in Germany, and do you expect this percentage to grow mid to long term in an overbanked market like Germany?
Michael, you seem very confident that this is going to be the case.
Yes, as already mentioned, yes. I think we have pointed out that I think that's true for all of the three of us, that we see really big potential for growth for alternative lenders, especially for debt funds. in the market. It's difficult to say what the share is. I think Ralph has already mentioned it in the early beginning. The share in the US and in UK is much higher because these countries don't have this overbanked market like Germany has.
Yes.
So the share, Hanno, it's difficult to say. I would say it's below. It's roughly. If I would have to say, guess 20% roughly. But I think more important is how the trend look like, and that's made for growth, I would say.
Trend is upwards. Hanno.
Definitely sharply increasing. I mean, I don't have an exact number either, but referring one more time to the MES report is definitely a number we have. When we did it the first time, subordinated capital, there were about 120 borrowers in the market at the time. Today we see 155 from our account that are active in Germany. And that's, I mean, you can see the increase and the volume definitely goes with it. So that number is definitely on the rise.
Very good, very good. Andrew, I think we just gone over the hour, so we should wrap it up. But I'd like to say I thought it was a good discussion. I think we've learned a lot. I hope our audience managed to take away quite a lot from your three very distinct different inputs into this. We look forward to the FAP mezzanine report, Hanno. That's going to be coming out next month. Good luck with the new fund, Rolf, and the same to you, Michael. All the very best. And look forward to seeing you again at hopefully again at another live event when we're allowed to get back out on the road again. Thank you all very much indeed. Is there anything else, Andrew?
Well, I just wanted to thank everyone on the panel, but also to thank everyone for attending. We will be posting this online so you can catch up and listen again, watch again, and remind everyone we have our third roundtable, a week's time, which is another Investing in Germany event, and we'll be discussing the office market in Germany. So thank you everyone again for your time. Stay safe, and we look forward to you joining us again soon. Good afternoon.
Thank you indeed. Thank you all of you.
Bye bye. Have a good afternoon.
Bye.